Hello and welcome to another edition of the Moving Iron Podcast. This podcast is proudly provided by Axon, helping dealers move more iron for almost 100 years. Find out more at axontire.com. Axon was started almost 100 years ago out of a passion for keeping agriculture moving. It's that same passion that drives them today. With a vision for a better experience for both farmer and dealer, they set out to create a better way to move more iron. When you partner with Axon, you get immediate access to a full range of products and solutions designed to meet the complex needs of today's grower. Axon carries all major brands and sizes of tires, wheels, and tracks. From custom colors and sizes to fully customized wheels, you can have the solution for virtually any problem today's farmer is trying to solve. To find more or become an Axon dealer, please visit axontire.com.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving iron.
Hello and welcome to Moving Iron Podcast Markets with Shawn Hackett. This edition of the Moving Iron Podcast is brought to you by Axon Tire, helping dealers move more iron for the past 100 years. For more information, go to axontire.com. Also, TractorZoom delivering insights. That's where you're going to find TractorZoom's iron comps. Great place to go see what's going on in the marketplace. They have about 500 different auction houses that report what they see happening out there in individual auctions. So 500 different data points out there to track what's going on. So if you're interested in following what's going on there and really track and see those trend lines develop, go to tractorzoom.com, go over to Iron Comps, and if you decide to use that, you get a discount if you use Moving Iron at checkout. So like normal, I have Shawn Hackett on here to come on and talk to me about what's going on in the marketplace. And Shawn, looks like we're in the cycle of lose a dollar, gain a dollar, lose a dollar, gain a dollar every week. And this week is no different. We lost a dollar last week, so we're going to gain it all back this week. So I guess what's your reaction overall so far this week in the trade? Looks like we're definitely developed that weather market is here to stay.
Well, it is, and we talked about how this warmer, drier pattern for the back half of July, we've been talking about this for months, was going to occur, and it would probably lead to a final surge. We've been calling a blow off top. Hasn't happened quite. It's happened in, let's say, canola. It's starting to happen in oats. It might be happening in Minneapolis wheat, but it hasn't happened in corn and beans yet. But we had this idea that we would have this final surge into the end of July before we felt the drought cycle would break in August. And the weather pattern is looking pretty much on target. The heat dome is moving more easterly, getting it over Iowa again, maybe western Illinois. The dry weather is going to recede to the southeast some. And so the market's starting to now view the glass as half empty. Last week it was half full. And, that's, as you said, that's kind of the market's been oscillating between, it's so good over here, but it's really, and it's having a hard time discerning what does all that mean. Then the USDA kicked the can down the road, as they always do in July, and said, we're not going to make any decisions right now. We'll worry about that in August. So that doesn't help clear anything up.
Yeah.
So we still hold to the idea, and by the way, I have no idea when the USDA will get around to saying it. We never know when they're going to come to the truth, but we still believe when it's all said and done, this weather pattern, how we think it's going to finish out, we still think corn yields, as an example, we still believe it's going to be in this low 170 area for the national average. 172, kind of like last year, a good crop, but a little short. Ultimately, the USDA will come to that conclusion, and when we run the various numbers of what demand could look like, we're going to sit around 1 billion to 1.2 billion, which is where we are right now. So we think ultimately corn's going to end up in the same place it currently is. Now, maybe is it going to take until January for the USDA to let us know this? It's possible. I think they'll get to the answer sooner, but. So what does that mean? That means that what's probably going to happen is that we're going to have this typical nosedive in August when weather improves, harvest pressure. I haven't sold. I got to get out, and that we're going to get that. We have to get that trade out of the way, and then we're setting up for a really, really interesting buying opportunity late summer, early fall as the market comes to rationalization, like they did last year. Oh my gosh, this crop is a little short, and I think that's the pathway. One more surge here. Producers start selling, get yourself well sold that you need to. And then the livestock producer get ready for a good feed buying opportunity late summer, early fall. And then we get into the winter time and all the stuff we'll be talking about on your show, at your conference, that what's coming that's going to lead to we think a pretty wild, pretty wild weather scenario as we move into the spring, summer of next year. So while volatility can be frustrating, it also allows for opportunities to do something smart. Mm-hmm. And so I think both sides are going to get to do something smart. The producer's going to get a chance to sell something here, and the livestock producers can get a chance to buy something here down the road just a bit. So we're looking forward to making those recommendations as they come along. So
let's talk about North and South Dakota for a while. They've made the news here. We've heard plenty of people talk about what's going on up there, and even into western Minnesota and northwest Iowa. As you start taking a look at how dry that is up there, and roughly 40% of the corn crop gets produced up there. Is that right? Between those four areas? North, South Dakota, Minnesota, something like that? I
think it might be the acreage.
Okay. Acreage, all right. So
I don't think it's 40% of production, but I think 40% of the acres. But of course, they don't produce the kind of yield they do. The way I think it works, if I recall, I think if you take Nebraska, Iowa, Illinois, and Indiana, I believe they represent 70% of the corn production.
Yeah, I think that's correct.
And I believe the Dakotas represent, like that 20 to 30%. And then of course there's outliers in the South and stuff. Right. But the acreage is, I think you're correct about the acreage. Yep. So when the USDA is talking about the acreage, most of those acres that were added, were all in the areas that are just completely burning. Who knows? It could be a zero in some of those areas.
Yep. Okay, so now you start looking at those areas and the amount of drought, especially in the Dakotas. They've had about a year-long drought now, it feels like, and it's gotten significantly worse over time. And you start looking at what's going on there, not more importantly with what's going on with the corn and bean portions of the market. But the other thing that's kind of being pushed to the back burner here a little bit is the spring wheat and the winter wheat that's up there right now. That's either didn't come up or it's struggling right now, and those different things. So as you look at the wheat market, based on what's to go left in Nebraska, we just started kind of cutting in my area. So Nebraska, North and South Dakota, as you take a look at those areas and on the wheat run, what are your thoughts there and how that's going to affect the overall wheat market?
Overall, the wheat complex is, especially the winter wheat's on a different cycle because we harvest, and so we're beyond the harvest pressure. We're moving to the post-harvest period where we tend to see prices improve. We've accepted whatever the crop is or it isn't. Whoever had to sell has sold. We're kind of gone through that. So we think wheat prices, there can always be a little downside heading into harvest pressure for August for corn and soybeans, but we don't think there's a whole lot of downside left in winter wheat. We think we're on the other side of it. The fact that we have such a shortage of higher quality wheat, a la Minneapolis spring wheat, especially also in the Canadian prairies, and the fact that the winter wheat crop, KC winter wheat crop, was lower quality in general, even though the volume seemed to be okay. We're going to where we think we're at is we have a high quality wheat protein shortage. At the same time, if we're correct about corn, we're not going to have a whole lot of corn again, which means feed wheat, lower quality feed wheat, is going to be in very high demand, and it's going to be wanted. It's going to be needed. So that's going to, and at these lower level of price, we just think the buyers are going to buy all day long here. So we like the wheat market here. We think that the wheat market overall is, in terms of winter wheat, is like bottomed out, carving out a low, going sideways. Spring wheat, is just we still don't believe it's priced in what has happened or what is still going to happen with the weather that's still to come. We still think at some point there's going to be a blow up top. If you look at a chart of canola, which is the Canadian prairies, one of the big crops in Canadian prairies, you'll see that it was meandering, and all of a sudden in 4 days, it put like $1.30 on the market in 4 limit up days in a row to place the blow off top. And then now it looks like it's kind of starting to come back down. We still think that's going to happen in spring wheat. We're going to get that final acceptance of what has happened. And we're going to go, boop, 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 boop. And within 4 days, we're going to go from 870 to 10 something and place the blow off top. So we think that's still out there for spring wheat. And once it happens, then it happens. And eventually you price it all in, and whatever happens, you move on. But we still think the market has yet to fully accept and trade what looks like it could be the worst crop conditions we've ever seen. It looks like we could actually see conditions possibly worse than 1988, which was a half a crop. So with the winter wheat market probably going to eventually do that soon. I mean, I don't think this is like a month away. It's probably going to do it here next 2 or 3 weeks. That should provide a lot of support for the winter wheat market too, because everyone's going to look for, how can I use some of this KC higher quality wheat? Can I mix it in? Can I do something to try to work it out? And believe me, you can do a little bit of that. So we're pretty constructive of the wheat market. We think the wheat market's usually bottoms first, then corn and soybeans bottom out later, and then the whole complex goes up later. So we think wheat's actually in a pretty good spot. If you're a buyer of wheat, of winter wheat, we think this is a good time to be starting a cash buy program. We wouldn't be wanting to wait too much longer for much, much lower levels at this point. So.
Yeah, I've noticed that throughout this wheat run here, that it seems like the bushels are there, plenty of bushels out there. Bushel average is kind of trending like we would see, but it's the quality that's coming along with it. It's not there as widespread as we'd seen in the past. So wheat market definitely will have some opportunities to take off and run. As you take a look at what's going on in the soybean market, soybeans have it seems like there's the corn kind of gets was taking the headlines right now when you start looking at things, but soybean market is kind of the sleeper out there when you start looking at how carryouts are playing out, and then what does that look like moving in to harvest, and what potential crop might look like as well. So I guess take a look at the soybean market and give me your reaction to that.
Well, the problem with the soybean market is that we had this record crop in Brazil.
Right.
So, that takes any scarcity trade off the table while they're exporting as much as they possibly can, which they are, of course.
Right.
Then you have the African swine fever Act 2 that's occurred in China, where they had to liquidate a massive amount of hogs again, and now the piglet prices are going through the roof because they got to rebuild again, and dry whey, which they use to feed the piglets, is going through the roof again. So you can see they're going to have to refire the cycle up, but that also keeps demand for soybeans and soybean crush and bean meal down for a little while because they just don't have as many, mature hogs to feed. But then, of course, guess what? Later in the year, when all those piglets become much more mature, and then you're going to have this massive feed increase again. So we're kind of in this zone with the demand side. If you look at the balance sheet, it says there's no carryout. Well, if the market believed that, we'd be at $18 soybeans, but it's not, because I think it realizes we might have a demand problem. It's possible Chinese overbought given what's happened with the African swine fever. So that's this delicate balance that the market's trying to figure out, is how much will the Chinese imports be down during this period, and how good of a crop can we have? In the end of the day, they're going to have to come for it anyway. It's a timing factor. Do they come for it now, or are they going to wait until the beginning of the year? So what we think is, we think that the market will probably want to price in a little bit of a scarcity trade here into the end of the month. They're going to say, just in case August is really bad, let's give ourselves some weather premium. So it wouldn't surprise us if we put $1 on the November soybean market as a, what if August turns out hot and dry? Now, that, by the way, we don't believe that's going to happen, but the market might just decide you know what? Let's be on the safe side. Let's put $1 on and just in case. And if it turns out the weather's good, we'll take that dollar right back off. So that's kind of where we think we're at. Still in the same idea of a final blow off top here, but we think the demand side is holding the market back, and this huge crop out of Brazil is holding the market back right now.
Yep. So here's one that we don't talk about much, but you do put a report out about it, and that is dialed in strictly to this, and it's the dairy market and what that looks like. So the dairy market right now, if you go back and take a look, take a look at what's going on, there is it's kind of fluctuating there. It seems like there's some pressure there. You'll see some run up and some run down, very much like you see here, but it's kind of hovering in that. We've come off some $18.5 highs, and now we're down back into the 17s. I guess as you take a look at the dairy market, what's going on there is some of this kind of high feed and those kind of things. Are they starting to play into that dairy market and how those prices are playing out here?
Remember, we got into that 19s right there in May, and then the government said we're going to end the food box program. We're not going to buy cheese anymore or other dairy products. We're just going to walk away. So the market said, "Oh," and it had the big sell-off,
right?
Because it has to get back to a real market where there's a real buyer, not a phony buyer, not want to say phony buyer, but a non-market driven buyer.
Right.
Okay. So we had this big crash into the engine. Now our smart money algorithm that we utilize capital flows gave us a strong buy signal a couple of weeks ago, and the market's actually rallied $1 off the lows already. We're starting to see them. And so what's been happening is that these low prices, producers are losing money, especially out west. They're losing a lot of money, like $1, $2, $3 per hundredweight money.
Mm-hmm.
Because the feed's too high, the price is not good enough. The very, very high heat that we've been having consistently out west has been knocking production off because it's been stressing the cows too much. And so all that leads into lower production and the idea of liquidating dairy cows for the hamburger meat market, that sort of thing. So we're starting to get production to come down, and of course, real demand's good. It's good because we reopened food service. Demand for dairy products is very, very strong, but we just had to take this artificial purchaser out of the way and re-equilibrate the market. So we're pretty constructive. We think, given the weather that we still see, which is really hot out west, idle in 10 degrees, big dairy producer, they're not going to, it's a big problem. So we think we can have a nice rally here into August before, we might be setting ourselves up for a kind of a late summer top here in the dairy market before we might roll over into the fall. So we think if you're in the dairy business, if you're a producer and you've been kind of struggling here, we think you're going to have a good opportunity to sell here as we move into August. And like I said, we're kind of setting up or preparing our dairy customers to get ready for that marketing opportunity. But it should be a good run here. And we don't think we're done yet. We think we still have quite a good runway. We think we get back to the 19s again, Casey, before we might, push against that upper resistance and may price this weather production scenario. And if feed prices come down as we're expecting here in the fall, then you won't need as high a price to keep the dairy guy making some money here. So
okay, all right, good stuff there. So let's talk about the cattle market. What's going on there? It's kind of bouncing around all over the place between what China's been doing with hogs, even though they're having they've kind of fessed up about this AFS thing, but they're still buying pork and those kind of things, and you're still seeing some beef exports go that way. As you look at what's going on in that protein complex, what's your thoughts there?
What's interesting is that once ASF hit in China, it forced consumers there to eat more chicken, to eat more beef, to eat more fish. And quite frankly, they said, we kind of like this.
Right.
They're never going back to eating as much pork as they did before. They will never go back as a per capita basis to eating as much pork as they did before. Permanent demand loss, permanent demand gain. Mm-hmm. So they've never gotten their hands around the beef shortage there. That continues to rage on, and that's not going to go away. But the domestic market, because we've been dealing with this throughput problem where we can't bring animals through the packing houses at the rate we want, it kind of takes the export market off the table as a driver, because you could double exports, but if you can't bring any more animals through, then all it does is it increases the beef price maybe, but it doesn't. You can't. It's like it's a cap. So the demand for beef is fantastic. It has been fantastic. It continues to be. In fact, we're not satisfying demand because we're not bringing the animals through. So one of two things have to happen. Either the packing houses got to get the capacity up. We keep hearing they're not going to do that much. They're going to just keep it the way it is. The JBS conference call we were on not too long ago when they did their earnings conference call, they have just no interest in doing too much. Just going to keep it the way it is. So what that means is in order to get either they just have to run these plants more efficiently, which they will, or we got to get the supply down. We got to get the animals down. We got to get the weights down. And when you look at the cattle on feed report, when you look at the weights, and when you look at what's going on with the drought out west, fertility cycle, what we think is going to happen with the winter, extremely cold, extremely long, very, very, tons of snow, blizzard conditions. All this says is that when we get to the spring and summer of 22, though the animal populations are going to be way down. Way down. Beef production is going to be way down. And what that means is, regardless of the packing house's current capacity, there's not going to be enough animals, and they're going to start bidding them up to bring them through because the demand is going to still be very, very strong. So it sets up a really exciting price opportunity situation to the upside later this year into the spring or the summer. In fact, we think it's possible, we could be making all-time new highs on cattle price when we get to the summer of next year. Like we could take out the highs of 2014. We think we could be setting up in a wild situation, which is not uncommon. It's not uncommon for that to happen when you have a big surge in feed prices, to have that start to happen, a little bit down the road. So for those producers who are struggling and have been struggling, we don't think there's a lot of downside here in cattle. We think the market can grind higher in the near term, but keep an eye on those deferred prices. Keep your powder dry. Let those. We wouldn't do a whole lot of forward marketing, I guess is what I'm getting at. We were pretty excited that if you can get through this patch, Casey, you're going to be doing really, really, really well in 2022. 2022 will be the year of the cattle producer, and it hasn't been that for a long time. So we're excited about that, and we're just trying to make sure our customers can get through and survive and get to that point. Just like the dairy people, a year ago if you could just get through, the better times are coming, and of course they did. We see the same thing happening for cattle. We're pretty excited about it.
Right on. Okay. Yeah, it's been a tough run for the cattle guy for the last couple of years here. So we'll keep that in mind. We'll keep watching that as that moves forward. All right. Last but not least, the one thing that I've been hearing more about on the financial shows, and talking about the CPI report came out, whatever it was, Tuesday this week or Wednesday of this week. CPI report came out, and obviously they're looking at inflation, those kind of things. But I've heard more about $100 oil in the last 7 days than I've heard about in the last 7 years. So I guess as you take a look at that oil market, what are your thoughts about the potential for oil to really take off and run up to that $100, and how much inflationary influence do you see there?
Well, first of all, just remember that inflation's relative to what it was a year ago.
Right.
So a year ago we had
exactly
a complete collapse in price.
Right.
So it's really a distorted view. What's the true price versus what it was prior to that? It's not setting 13-year highs. I mean, I'm not saying there's not some price increases, not some inflation in the system. Of course there is, but it's not. 6 months from now, it's going to be very, very, much. We're going to keep going lower, because we're going to be comparing, prices to, as prices start to rebound. We're going to be comparing it to a higher level. So it makes good headlines, but it really isn't quite as inflationary as everyone is suggesting. Now, a year from now, if we're showing those same numbers against today's prices, then that would be really, really worrisome. But we're not sure we're going to necessarily see that. But having said that, the crude oil price, it's always a geopolitical chess match in our view. It's always been, what's the game plan? What's the big picture? So when you went back when the Saudis decided to flood the market with oil and crush it from 60 to 30, and then we went to minus 35 when we had the virus, That was a geopolitical gamesmanship. That was a chess match, and they decided they were going to crush the market to try to hurt the U.S. fracking producer.
Right.
And now they've decided they want to, and the policy's been, we're going to hold the oil back because we want the price to go higher. And I'm not, and now we're here at 70, 75, and I'm not sure we're experts on Middle East geopolitics. We do our best to understand what these guys are trying to do and what the whole game plan is with Russia and everything else in China. But I don't think they want the U.S. fracking producer to make all kinds of money and start, adding rigs again and getting production going again. And I think they want us to stay depressed. And I don't think they can let the oil price get much beyond 70 or 75 before we don't need the banks to loan money to the oil producers at this price. They'll self-fund themselves, okay? So if I'm correct about that, then there's a cap here. I think we're capped at 75. I think they will say whatever they have to say, produce whatever they have to produce to keep the price capped at 75 or less. I'm not saying they want 30, but I don't think they want it over 75. So I given that I'm correct about that assessment, I think the upside in crude oil for right now, I don't think is very good because I think they have tons of spare capacity. They could turn it on anytime they want, and they could drop this market $10 anytime. They could just like that, and it's down $10. So with that in mind, of course, I could be wrong with that geopolitical view, or something else could happen. There could be, some terrorist attack or something. But I really don't think there's a whole lot of upside to 75. And if you've been looking at the chart, Casey, 75 and then backs off. 75 and now it just backed off again. It just seems like there's a wall at 75. So I think I might be right about what I'm saying. I think.
Yeah. Last time they did that, Russia said something to the effect of, "We're not going to do what you say, and we're gonna do our own thing." And they're like, "Oh, are you? Okay, right." See how well that works out for you. So yeah.
All I know is that they start seeing the U.S. rigs going up, and they start seeing production starting to turn back up. Ain't gonna they don't want that. They want to keep us down. They don't want us to be the largest producer in the world and energy independent. That does not work for them, quite frankly.
Yeah, it's bad for their business model.
Their business model gets blown apart.
Yeah, tough for their business model for sure. For sure. All right. Well, good stuff as usual, Shawn. Folks want to reach out to you and get some more information about what you've got going on. You've been a busy man here of late. You think you put out about 3 reports this week, and all of them are chock full of great information. Folks wanted to see some sample reports or just ask you some questions. What's the best way to do that?
Our website is Hackett, Hackett, advisors.com. All kinds of information on there, interviews, white papers, sample downloads. We just recorded a podcast yesterday, as you know, Casey. We kind of laid out some of our thesis about second half weather, La Nina returning, a lot of things we'll be talking about at your conference. So if anyone wanted to take a look at that podcast, we think it's kind of really sets the right framework for what to expect with South American growing conditions, early start to the winter, a lot of things that we've been talking about in your program for a long time. We'd be happy to send it to them if they email us at Shawn, SHAWN, at Hackett, Hackett, advisors.com. We'd be glad to send it to them and get them up to speed with what our research and climate algorithm is saying.
Right on. Yeah, folks, reach out for that. That's a good information there, man. There's a lot of great stuff that's in that podcast. Gave it a listen the other day, and it'll make you think. So, Shawn, reach out to Shawn there at what's your email one more time, Shawn?
Shawn, SHAWN as in Nancy, at Hackett, Hackett, advisors with an S.com.
Right on, man. All right, Shawn. Well, thanks for being on the podcast, bud.
Thanks, Casey. Appreciate it.
Right on. I'm Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram. That's where you're going to find the latest editions of the Moving Iron Podcast. Also, go to MovingIronLLC.com. That's where you're going to find the entire library of the Moving Iron Podcast, as well as any blog posts I have out there. Also, you'll find all the information for the Moving Iron Summit that Shawn's talked about here in this podcast. It's a great information gathering place to go see what's going, kind of what's going to happen for next year across a bunch of different segments, as well as what, great place to network with other folks too. So for across all the spectrums of the equipment business. So if you're interested in doing that, go to the navigation bar, click on Moving Iron Summit, and all the information is there for the agendas, how to book rooms, registration information, all that stuff's there. So check that out, and you'll get all the information you need. And you just see Shawn's bio and his pretty face if you haven't seen it yet. So you're gonna it'll be well worth your trip to go check that out.
You need to talk to my wife.
So yeah, check that out. If you need more information about that, hit me up at Moving Iron Podcast at MovingIronPodcast.com, and I will get you all the information that you need. So with that, I am Casey Seymour, Shawn Hackett. Let's glue some iron, folks. Out. You want to have a meaningful competitive advantage to help sell more equipment. Whether you represent the sales, parts, or management department of an implement dealership, there's a surprising amount of complexity when it comes to tire, wheel, and track technology. Let Axon worry about that so you can get back to supporting your customers. Axon has leveraged years of experience to create a streamlined process that gives you a proven path to help today's grower and sell more equipment. The roots of their organization go back almost 100 years to the invention of the rubber tractor tire. Supporting agriculture is the number one driver of Axon, from product development through sales and service. To find more or become an Axon dealer, head over to axontire.com.
Moving higher in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years you'll find us here. Moving higher.